This week, the Fed announced that they would pause rate hikes this round, however, foresaw continued rate hikes in the future in order to continue its fight against inflation. So in doing so, it's created, I think, some shifts in the market, and we're going to highlight those and talk about the benefits of spreading your risk. So stick with me. My name is Brian Cannon, and welcome to Markets in 5. Real quick before we jump into relative performance and spreading risk, let's talk about the market real quick. So this chart's going to look familiar from prior Markets in 5, as well as if you look at our stock market updates in the meantime. But we've had a couple of things occur since our last Markets in 5. Essentially, RSI has dipped back down below 50. We really want to see that above 50. Below 50 creates chaos in the markets, and so it could bounce down there and bounce back up quickly. So we're watching that closely. But when when you're looking at RSI, again, if it pops up, it's usually because it finds some support from a pricing standpoint. And so I've got highlighted in green 4 areas and 1 red that I think would serve as very, very logical support zones. Some of them are the channel trends on the up channel trend, and some of them are the moving averages. What's interesting is we're right here at this point, which is served as a very, very strong support zone multiple times throughout this entire higher high, higher low up channel trend we're in. And so with all these blue arrows that it's not exactly to the penny that was held, but it was very, very tight range in which it was held support and moved on. So we would really like to see this area held in a very good fashion. So again, if it comes down and intraday touches this 100-day moving average and moves back up into the zone, that's great. In fact, that's a really good signal. However, if you move down with high volume and break this support zone, this red circle area, then you can assume that you're going to at least come down here and touch the channel trend support, and then your last line of defense is really the prior tops, as well as the 200-day moving average. So if that breaks and it goes, then you can assume that we're going to go down much harder. I'm not assuming that right now. In fact, I guess I'm hopeful that as we kind of get through the doldrum of September, that we can really start to move into Q4, start to gain some momentum, and really hold one of these near-term kind of support zones and head back up. So, but if not, we've got to be prepared to take assets off and go back into protection mode. All right, I'm going to go through a couple of examples of how we can use relative strength in order to determine where we need to spread the risk based on the moves in the market. So up on the screen, we've got XLP. XLP is your consumer staples, very defensive type category, right? So generally doesn't do very well when the market's going up, and generally holds up much better when the market's going down. So it's filled with need to haves versus nice to haves. So Band-Aids, toilet paper, food, those types of things that are pretty stable in value, usually pay dividends, but don't have a lot of growth associated with them. So if we look at the XLP year to date, so from January 1, basically, the index is the sector itself is down about 2.5% year to date. So if we compare that against, for instance, the S&P 500 ETF over the same period of time, S&P is up about 16, and the consumer staples is down about 2.5. So that's a big spread. So you would say, well, why would you ever put money there? Well, it's because there are periods of time, again, when the market tends to struggle. Consumer staples tend to do quite well. They hold up much better because, again, they're filled with companies that pay dividends and aren't maybe leveraged quite like some of the growth companies. And so we use our indicator, our Cannon IQ strategy, to say, hey, it's either a good time to buy and be in this sector, or it's a bad time to be in this sector. And so we kind of can rotate this over time. But then also what we do is we're going to compare the relative performance. And this is where the magic of this strategy comes into play. So if we kind of look at XLP relative to the S&P 500, then we're not looking at the XLP, nor are we looking at the S&P 500. We're looking at the XLP divided by the S&P 500 to determine is it outperforming or is it underperforming. So obviously in periods of times where it's going down, we want to not be in it. And there's periods of times when the market probably is a little bit more turbulent or heading down that it kind of makes sense to shift some money that way. So we have not had a relative strength breakout quite yet, but it looks like it has potential to do so. So it's got a little bit of overhead resistance with some of these moving averages. I think if that broke out and the market continued to drop, then it would be a good idea to shift some monies over there. So another example of that would be if we looked at energy. Energy, again, this is the relative performance of energy relative to the S&P 500. So you can see when 22 occurred, we got buy signals from our strategy saying, hey, buy energy, buy Exxon, buy Pioneer, buy ConocoPhillips. All the energy companies essentially did very well in 22. While if we looked at the sell signals on the S&P, it would be sell Apple, sell Amazon, sell Meta, sell Google, sell all these companies that traditionally do very well. And so we want to use this relative strength performance to say, okay, no longer should we avoid energy or be out of energy, and we want to be in it. In fact, we might even overweight it. And so we use that relative strength performance to help us determine how we should spread our risk relative to the rotation that's happening into the market. So in wrapping up, I think you can see that the relative strength is very important in order to keep your eye on as far as identifying when shifts in the market occur and how to properly position yourselves relative to that shift. So if you have any questions, give me a shout, but I look forward to seeing you in the next Markets in 5.